Hey, we're going to take a look at some of the steps needed to create charts, graphs, statements for the financial section of your business plan. So in the next 10 minutes, we're going to create the cash flow graph, the break-even analysis graph, figure out how much funding we need, and create the pro forma income statement, cash flow statement, and balance sheet for the first year. So all I've written down so far are expenses and sales for each month for the first 3 years, all the way up to month 36. These two steps are arguably the most difficult and the most important. You need to make sure your expense list is exhaustive. You've included anything you think you're going to need, and you've done the research to figure out how much it's actually going to cost. And then with sales, build up those sound, logical assumptions to project out your sales. And what we're going to see now is that once you have those two steps completed, 95% of your work is done for doing this section of the business plan. So the first thing we're going to do is complete these two rows, the cumulative expenses and cumulative sales. So let me just add in a formula, bring that over. So all we're doing here is we want to see for each month how much expenses have we accumulated to date, and we're going to do the same thing for sales. Now these two rows are going to be really handy when we're trying to create our cash flow graph and our break-even analysis chart. And it's also going to come in handy when trying to figure out how much funding we need. The last row, the plus minus row, all we're doing there is taking our sales and subtracting our cumulative expenses. So to that date, what's the difference between our cumulative sales and cumulative expenses? So we see at the beginning, expenses to date are greater than our sales. Eventually, that turns around and our sales are greater than our expenses. There's 2 points in this table that I want to point out right now. The first is when you're looking at the plus minus row, the point where it goes from negative to positive. That's going to be your break-even point. So sometime between month 31 and month 32, that's when we break even. The other point I'm interested in is on the plus minus, where is it the most negative? And we see at month 17, it's minus 44. You know, it keeps getting more and more negative, and then at this point, it starts heading back closer and closer to zero. This point's going to come in handy when we're figuring out how much external funding we need. All right, the first thing we're going to do is create the cash flow chart. So we're going to make a line graph. And all we need for this is the XY the plus minus row. So you guys are going to make this graph look a lot nicer than I did, right? But you're going to do all the axes and all that good stuff. Bring it over. So here, this is the cash flow graph. So the point when the line crosses the x-axis, right around month 31, that's the break-even point. And if you remember, this matches up with one of the points we bolded, where we go from negative to positive. That's our break-even point. The other point to note is when this is at its most negative, the lowest point in the trough, and that matches up with month 17 at minus 44,000, right there. So if I was making this graph, I'd want to label the lowest point, minus 44,000. As an investor, I want to know how risky this is at the lowest projected cash flow spot at minus 44,000. I'd want to label when we break even at month 31, and I'd want to see how big the upside is from a cash perspective. So at the end of 3 years, we have 33,000 net cash flow. The second chart we're going to make is the break-even chart. So for that, we're going to make another line graph, and For this, we're going to look at the cumulative expenses compared to the cumulative sales. So we're going to take that row, and then we're going to add to it the cumulative sales. And what we're really looking for here is the point where these two lines intersect. So right there, as we'd expect, it's right around it's right around month 31, which matches up with our other chart when the other chart crosses the x-axis. Those should match up. The other comparison between these two is the point where the expense line is furthest away from the sales line, right around here, matches up with the lowest point on this graph at month 17. All right, so we have those two charts complete. The next thing we want to do is figure out how much funding do we need. So we're going to come back to that point where plus minus is at its greatest negative, because this is our biggest cash hole right here in month 17. So we need to make sure we have enough cash on hand to cover that. So that means, based on these projections, we need $44,000 in cash. But remember, these are just projections, so we want to add in a buffer to protect ourselves. So let's say we add in a bit of a buffer. At the end of the day, we say we need $55,000 in external funding. All right. Next thing we're going to do is we're going to create the 3 financial statements for the first year. We're going to start with the income statement. One thing we need to assume is how much we spent on PP&E, or any kind of asset that we're going to have to depreciate. So cars, computers, printers, all that good stuff. So let's say we spent $8,000 on PP&E and we're depreciating it at 25%. So you would have already figured that out on your more detailed expense sheet. So now that we have that figured out, the first thing we're going to put on our income statement is revenue or sales, whatever you want to call it. So we want to see at month 12, the end of the year, what are our cumulative sales? It's $7,000. So we just bring that over. We want to figure out what our expenses are. At month 12, we've spent $46,000. Remember, we're not going to put $46,000 in this space. We're going to do $46,000 minus the $8,000 on PP&E. Because we need to treat the PP&E separately than the rest of our expenses, because we're depreciating this. So we don't want to have to include the entire $8,000 on the income statement for this year. So now we're going to come in and we're going to calculate our depreciation expense. 25% of $8,000 is $2,000. Pre-tax income is going to be minus $33,000. Tax, we're not paying any tax because we are operating at a loss. So our net income is minus $33,000. All right, now we're going to move over to the cash flow statement. The first thing we're going to have on there is our net income, right from the income statement, minus $33,000. Now we're going to add depreciation, because here we want to reconcile all the times where net income is going to be different from cash. And remember, depreciation is a non-cash expense, so we need to add that back in. Under investing activities, all we're going to have is our PPE expenditure, which is $8,000. And under financing activities, we're going to have our equity financing. And that's the money we got from external funding. And we said on the last sheet that we're going to ask for $55,000 in funding. So cash at the start of the year is 0. Cash at the end of the year is $16,000. So that's how much cash we have at the end of the year. The last statement we're going to do is the balance sheet. So we're going to start with assets, cash, $16,000, coming right from the cash flow statement. PP&E, what's that going to be? Well, we spent $8,000 on PP&E, but remember, it depreciated at 25%. So at the end of the first year, it's worth $2,000 less than it was at the start. So PP&E is going to be $6,000. That's all we have for assets. So assets, 22,000. Let's take a look at liabilities. We don't have any liabilities. What about owner's equity? We have our contributed capital, which is the money we got from outside sources, which is going to be the same thing as our equity financing, 55,000. And then under owner's equity, we also have our retained earnings. We don't have any dividends, so that's just going to be whatever our net income is, which is minus 33,000. So combined liabilities and owner's equity equals 22,000. The balance sheet's balanced. So as you can see, once we have the expense and sales projections on a monthly basis, we can very quickly create our cash flow graph, our break-even analysis graph, figure out how much funding we need, and create the income statement, cash flow statement, and balance sheet pro forma statements.